Okay, so this is part 2 of chapter 4 video, and we left off at steps number 7. So here we have our end of period spreadsheet with our adjusted trial balance prepared. Now at this point you're ready to move on to step 8. We did financial statements, prepared financial statements in chapter 1, so you already know how to do this conceptually. However, the financial statements in chapter 4 are a little more detailed than the ones in chapter 1, and they're called a classified balance sheet and a multi-step income statement. So what I want you to do is I want you to look at the difference between a classified balance sheet and a normal balance sheet from chapter 1. The balance sheet in chapter 1, all the assets were just totaled up in one grand total. In a classified balance sheet, they're broken up between current and non-current. Same with the liabilities. In a normal balance sheet, or just a plain balance sheet, all the liabilities would be totaled up in one main total, but in a classified balance sheet, they're distinguished between current and non-current. Also make sure to look at the difference in chapter 1 and 4 income statement. The regular income statement in chapter 1 had a revenue account and just all the expenses together in one total, and then a net income number. Which is considered single step. So the income statement you learned in chapter 1 is a single step. If one total is in that income statement. A multi-step income statement in chapter 4 includes 3 totals. So you have, your first total is gross profit. So we're going to subtract out cost of goods sold first. Then you're going to have a total of operating income is your second total, where you take out the rest of the expenses. And then you'll have some other items that come out of operating income, like interest or dividends or interest expense, interest income or interest expense. Anything that's not part of our normal operations comes out or is added last to arrive at our last total, which is net income. So spend some time looking at the differences between your chapter 1 financial statements and your chapter 4 financial statements. Okay? Step number 9, closing. So we haven't done that yet. So after we get to this point where we are at an adjusted trial balance, then we can see that all of our assets and liabilities here will end up on our balance sheet. These two will end up on our statement of owner's equity. And the last accounts listed go on our income statement. So once we post these last amounts on our income statement and we prepare our financial statements, we need to roll all of this activity in our income statement up into our capital account and start over the next period. Our balance sheet will keep rolling balances, but our income statement starts over from 0 at the beginning of every month. So once we have this month's activity, we need to close all the revenue and all the expenses, and this drawing here will start over. We'll put in capital too, and we will close those accounts at the end of the month and start over from 0 at the beginning of next month. So it's a 4-step or 4 journal entry process. Step number 1, close revenue. Okay, revenue is sitting on the balance sheet, on the income statement right now at $23,450 credit balance. So to make it 0, we're going to put it into or we're going to debit it, fees earned. So now fees earned is 0 because we have debited it and it was a credit. So now it's 0. We're going to put it in a temporary account called income summary. Income summary does not show up anywhere on a financial statement. We only use it for closing entries, and then we make it 0 too, so we don't put it on a financial statement. Second step, close expenses. Right? So all of our expenses are debits here, so we're going to credit them to make them 0. So I'm going to start with my credits first. I think I got them all. There's 6. I forgot one here. 450. Okay, so now all of those are 0 because they were a debit, and now I have credited them. So all of those are 0. We're going to put them into an income summary, which totals to 51.50. Okay, so at this point we need to do like step 2A, which is figure out what is the total in my income summary account. So to do that, figure out how much do we have in our income summary account right now. Let's do a T account. So we credited it first for $23,450, and then we debited it again for next for $51.50. So if we add on all our debits and subtract our credits, we end up with a credit balance of $18.30. So the balance in our income summary is actually going to be the same thing as net income. That's what that number represents, because it's essentially revenue minus our expenses. So the number sitting in income summary right now is net income. So we're going to close as step number 3. We are going to close income summary to our capital account. So step 1 and 2, we figure out what is income summary, what is net income, and then we're going to close it to capital. So our income summary is a credit balance of $18.3. So we're going to debit it to make it 0. And our capital account is Stacy Kelly Capital, and we're going to credit that for $18.3. And the last thing that we do, step 4, so closing entries are 4 steps, is we're going to close our drawing. So every period we're going to close how much our owner drew out of the account into our capital account. So we had $6,000, see that right here, of a debit balance in drawing. We need to credit to make it 0. I'm going to start with the credit first. Stacy Kelly drawing, $6,000. And we're going to put it, so now drawing is 0. We're going to put it in the capital account. So And it actually, you see, since we were debiting the capital account this time, we are reducing capital by the drawing. So that makes sense. If your owner takes money out of the company, then it should reduce their capital account. So by debiting capital, capital goes down. So let's see what our ending capital is. Do a T account. Now we started off with $30,000 in this account. And I know that because that was the beginning balance, and you see 30,000 was the balance that we had in there to begin with. And then we credited capital for 18,300, which is our net income, increasing our capital. And then we took out our draws, decreasing our capital. So the ending balance in our capital account is 42,300. Okay, so this should look pretty familiar. This should look like our owner's equity statement. You start off with beginning capital in owner's equity statement. You add net income. You subtract withdrawals, and then you get ending capital. So ending capital is going to be the number that ends up on our balance sheet. Well, step 10 is essentially only balance sheet accounts, closed balance sheet accounts. Notice there are no revenue and expenses because they're all zero. We have assets, we have our liabilities, and we have our closed capital. So this is going to include all of, you see this is the same number, all of the net income rolled into capital, and we took out withdrawals and closed our draw account. So this is a post-closing trial balance. We'll know it's a post-closing trial balance because there will be no revenue or expenses on it. We have zeroed all those out. And this is what trial balance we will start with at the first day of the next month to start recording our transactions again, which is step 1 of the accounting cycle. We'll start back over at step 1 next month, recording new transactions of expenses, new transactions of revenue, and we'll go through the whole cycle again. So there are 10 steps that you need to know. And the new things that we learned in Chapter 4 are our different financial statements, our closing journal entries, our post-closing trial balance, and then we also learned about this end-of-period spreadsheet where we learned about an adjusted trial balance. Okay, so that is Chapter 4, and good luck on your homework.